Hey folks, Serge Berger here. I wanted to have a look at the market here, just real quick, kind of giving you guys sort of the latest, front and center thoughts here that we've also, of course, shared with our clients over the past few days. And I wanted to just make, I guess, two quick points, and I think this is imperative in terms of where we are in the market. Number one, I think we have a potentially binary outcome in terms of the broad markets here later on this week. We're talking about October 10th and 11th, 2019, with these US-China trade talks apparently resuming, and maybe we get some sort of more clarity one way or another, right? So basically what I'm trying to tell you, if we just quickly go to the S&P 500, what I'm trying to tell you is that I think we could have, if we have a positive outcome to, or at least some marginally positive outcome to these trade talks, I think stocks could easily rally 5+%. Entirely possible. On the other hand, if nothing material comes out of these talks and maybe a bit more uncertainty, or at least, yeah, I guess more uncertainty, which even that would give us more clarity, meaning that there's not an imminent trade deal. So if that happens, I think we could quickly drop 5%. So we call it binary outcome, a binary situation in the market. Binary meaning there's an equal chance, basically, of either a really good, a good outcome to the upside in this case, or again, obviously stocks dropping. There's really not much in between that can happen, I think, from that perspective. So this is really kind of like the mother of all uncertainty events, at least so far. I think in 2019, this is probably about as big as we're going to get here. At least that's my perception. I'm not asking anyone to agree with me. So just my point of view. So given that situation, the question one has to ask themselves is, and this is more so for people who are using options. If you're not using options, this in itself here is probably a thought here that I would just mentioned. But if you are looking at options, the question is the VIX, is implied volatility too cheap? In my personal opinion, I think it is too cheap. Right now we're talking about the VIX around 17, 18, and considering the completely uncertain outcome here in the near term, and I'm talking about the near term, I'm talking about the next like days to week and a half or so. To me, this just seems like the VIX is too cheap. Now, there's a very specific trade idea that we offered our clients. I'll tell you that it has to do with buying an at-the-money call and an at-the-money put in the S&P 500. Don't want to go into much more detail than that because that is reserved for paying clients. But the point is, I think one wants to take advantage of the implied volatility being at least a little bit too cheaper to the lens of the next couple of weeks or so. So again, really just kind of wanted to bring this bring this thought to mind that considering what's at stake here with these China trade talks, it seems to me like the outcome in terms of market directionality is really only either we rally quite sharply or we basically resume the sell-off we've had over the past couple of weeks. I don't think there's really much in between. I suppose we could get a bit of a pause if they're kind of managed to thread the needle, which I don't know if they can. But even after that, we would either then continue higher upon corporate earnings season or go lower, based on that as well. So even if we don't get a move immediately after US China trade deal, which I think is unlikely, but even if we don't, then I think we'll get a sizable move up or down from corporate earnings season. So just some thoughts here, and again, the VIX in my opinion a bit too low. Point here is really more about giving you our thoughts. Sometimes right, sometimes wrong, but the point is that it's always honest. And hope this makes sense. Give us a thumbs up, share the channel, and I will talk to you soon.